Hi, very good afternoon to all of you. If you look at global economy, there is a fundamental shift happening in the economy, where from globalization we are going to protectionism. From having excess liquidity, we are going to relatively tighter liquidity. From zero, negative, and low interest rates, we are going to higher interest rates, which will start coming down, but will still remain elevated. From not bothering about environment, now every country will have to worry about environmental and social norms. Dominated by US, now we have two blocks, US one side, China, Russia on the other hand. And more importantly, technological disruptions are coming at a scale. In that background, commodity prices have started correcting over last 1 year. Energy related commodities like gas have corrected far more. Gold is more or less trading near 52-week high. Drop in commodity have ensured that inflation starts easing off. And more importantly, in going forward, inflation should remain on a lower side. As inflation came down, every central bank around the world started cutting rates, bearing exception like Japan. Most central banks around the world are now looking to cut rates. As interest rates come down, the $300 trillion debt burden on global economy will start easing off. Today, compared to about $100 trillion GDP, the debt burden is almost 3 times more at 300 trillion. China has diversified its dependence on US. Their exports to rest of the world, excluding US, has kept on inching up since last 20 years. And now US and rest of world is almost similar at 15-16%. Undoubtedly, China has its own challenges. One, their PMI data is reaching into contraction territory, and merchandise exports have continued to grow, but albeit on a dumping by Chinese companies. After withholding information about youth unemployment for a while, now China has come back with the numbers. And compared to last year, the youth unemployment number is lower at 17%. One doesn't know what happened in between. I had the opportunity of interviewing Professor Nouriel Rubini at World Global Leader Forum in Delhi. Dr. Rubini, better known as Dr. Doom's Parma Bear, was relatively cautious on global economy. He believes there are 10 mega threats from environmental side to geopolitics, which will come and disrupt global economy. As of today, we are seeing risk off in global market. There is fear whether US is going into recession or there will be soft landing. Israel-Iran conflict, will it escalate? Unwinding of yen carry trade, is it behind or there is something more in pipeline? Is China slowing down significantly more than expected? And how many more Bangladesh kind of crises can come where governments can change overnight? This confusion is also there in the market. Stocks are falling as if big tech bubble has popped. Nvidia's price movement is now running into hundreds of billions of dollars every day. Oil prices have fallen below $75 as if we are entering into a recession. Gold prices have also corrected as if rate cuts are going to get cancelled. Bond prices are falling as if inflation is on the rise. Natural gas prices have corrected as if there is no demand. And crypto assets have also fallen as if risk-off has happened. Clearly, we are in a global economy where there are challenges. US Fed continues to do a good job. They are managing liquidity and growth in a positive manner. They have taken out about $2 trillion worth of liquidity compared to about 5 trillion added. So there is net addition of close to $3 trillion of liquidity since the COVID crisis. The US growth has remained positive territory. It has not gone into recession, primarily driven by these large deficits. This deficit was during World War II. This were probably the Gulf crisis. This was subprime crisis, and this was COVID crisis. If you see today's fiscal deficit, it's reasonably way above almost all the other crises. In a normal time, to run this kind of deficit means two things. Growth will not falter, but your debt will keep on increasing. The US debt now is $35 trillion. This is resulting into their interest burden crossing $1 trillion despite expected interest rate cut. The job growth in US has started moderating, and numbers have now started coming in negative, indicating unemployment is on the rise. Market expects US to do a soft landing, but in a bumpy manner. The Fed will have to cut rates in September 24 without saying that US economy is under pressure because there is election in November 24. In that context, Indian economy is doing well. Headlines are all positive. We look far better compared to all other emerging markets in various parameters. Our next best competitor is 10% below us. The infrastructure which we built over 10 years between 2014 to 24 is improving our efficiency. The turnaround time at ports, for example, is down 70%. The road construction has grown 3 times. So overall, there is huge amount of efficiency in Indian economy. This is reflecting into our rising share in world goods export of both goods as well as services. The capacity utilization is now above 75% for some time. And if PMIs are an indicator of capacity utilization, they should keep on rising slowly and steadily. Rural economy was little bit subdued, but now tractor sales from turning negative last year has moved into positive territory. Monsoon has been fantastic. This has resulted into Kharif crop acreage of about 2%. The drop is only in cotton and jute products, but there is significant increase in pulses where our imports were increasing at a rapid pace. More importantly, in rural India, importance of agriculture has started coming down. Now, half the workers are employed outside of agriculture in industry as well as services. GST collections are remaining about 1,75,000, above 1,75,000 crore for some time. Monsoon has been above average. And bearing northern India, reservoir water level across east, west, central and south India is above 10-year historical average. North India anyway is river fed to a great extent, and hence reservoir levels would not impact economy or rural India as much. Oil prices have corrected now to $75. because of heat wave and election, the government's award of tenders and contracts had slowed down in first quarter FY25. We believe in second and third quarter, it should ramp up significantly. With government orders coming into play, we believe infrastructure investment will start moving up, and investment as a percentage of GDP will continue to remain in a positive territory of 30% plus. There is massive disruption coming on technology side. Fortunately, India is taking baby steps, not comparable to US or China, but certainly ahead of many developed nations like Germany, UK, South Korea in critical tech areas. On that positive notes, there is also sign of caution. The GDP growth in first quarter FY25 came at 6.7%. Obviously, this is on a base which was much higher last year at 8.2%. Economic activity in July, partly impacted by high monsoon, has kind of remained flat instead of going up. The manufacturing PMI output came down a little bit in the month of August and was at the lowest level in last 7 months. If we look at automobiles, the motor car demand has started showing negative growth for some of the larger players like Tata Motors, Hyundai, and Maruti Suzuki. The positive is on the two-wheeler sales led by rural India. Those numbers are fairly decent at 18% plus. Microfinance are witnessing higher delinquency, and it has kept on rising over last 5 quarters. 30 days, 60 days, 90 days. All delinquencies, while are within control, have started moving towards the higher range. Lots of positive news, some cautionary tale, but our economy is doing reasonably well. Now convert this into equity markets which are at lifetime high. One reason is that profit to GDP ratio is about 5%, on its way to about 5.7% of GDP, bearing the 2007-8 period where there was excessive lending by banks which resulted into NPAs. We have never seen this kind of profit to GDP ratio. The other way to look at is over last 10 years, between FY10 to FY20, profit moved from 62 trillion to 113 trillion rupee. Profit moved from 3 trillion to 4 trillion between FY10 to FY20. And as profit growth was tepid, market cap moved from 62 to 113. But between FY20 to FY24, profit multiplied 4 times from 4 to 115, and market cap multiplied about 3 times from 113 to 387. If you look at this period, FY19 to FY20, profit as a percentage of GDP tripled from 1.6 to 5. Same thing happened in absolute numbers from 4 lakh crore becoming 15 lakh crore. This strong profit growth has ensured that markets continue to trade at a higher level. Our market cap to GDP ratio is about 143%. Historical average is about 84%. If market has to trade at historical average, Nifty should be somewhere around 17,000-18,000, not 25,000. We believe that is unlikely to happen because profit growth has been spectacular. We contribute about 3.6% of global GDP, but as of today, India's stock market capitalization contributes 4.6% of global GDP, global market cap. against 3.6% GDP contribution. We are 4.6% of global market cap. We are one of the few countries in the world where market cap is much higher than the GDP. The profit growth ensured that valuations have remained around historical average, little higher in mid cap and small cap, around average in large cap. The premium for large cap is about 14% to historical average and about 42% in small cap. However, the composition of index has also changed from government companies to private companies, from global companies to domestic companies, and from B2B to B2C. If you add Titan, Trent kind of consumer companies in Nifty index at 100 PE, obviously Nifty's index PE will go up. The other way to look at this is the PAT to GDP ratio and market cap to GDP ratio, how they are moving. In large cap, the gap between market cap to GDP and PAT to GDP compared to historical average is fairly reasonable, fairly small. In mid cap, again, market cap to GDP ratio and profit to GDP gap is still fairly narrow. However, in the small cap, the gap is fairly wide, and hence one needs to be a little bit cautious on the small cap space. If we see total market cap division between large and small and mid, when large caps were 80% of total market cap and small caps were about 20-odd%, large caps underperform and small caps and mid caps delivered. Today, large caps are just 62% of total market cap and 38% is with small and mid cap. Chances are that now large, mid and small in terms of expected return will come down dramatically. They will all narrow down in a small range. The other reason why markets have done exceptionally well, the domestic investors' participation. Foreigners are today at a level lower than what they were in 2013. Retail investors have taken their space by increasing their holding from less than 18% to more than 24%. This domestic participation has also provided support to our market. Foreigners, they are behaving like a revolving door policy. In CY22, they sold 17 billion. 23, they bought 21 billion. Jan, April, and May, they sold. Feb, March, June, July, August, they bought. Their behavior is like a revolving door. आ रहे हैं या जा रहे हैं, ये कहना मुश्किल है. We believe there is a very good opportunity that foreigners may turn buyer in Indian market despite valuation. As America starts cutting rate, dollar will become weaker, and weaker dollar generally results into flow coming to emerging market. As per one report, India's weight in MSCI emerging market is now more than China. If that is true, then a large portion of this flows will come to our market, and that will add fuel to the fire. The other way to look at our market, a lot of our performance is through P ratio expansion rather than profit growth. For example, in large cap, earnings have grown by 13%, but P's have moved up by, that's a fair interpretation, I say implied. So it's a P re-rating, right? P re-rating. Yes. The P's have been re-rated by 19%. In mid, the ratio is 50 or 5% versus 47%. In PSU, it is 17 versus 72, where floating stock is limited. the performance has been spectacular, where floating stock is more performance is not that good. So to some extent, our market journey is driven by PE expansion in low float counters and in small and mid cap compared to large cap. This is interesting comparison I picked up over internet. If you look at Daikin, which is the world's largest AC company and whose Indian subsidiary is the largest AC company in India, they are trading at a market cap to sales of about 1.4. A Blue Star trades at 3.3. The Ethos is trading at about 7.5 market cap to sales, and Swatch is trading at about 1.3. The Hindustan Aeronautics market cap to order book is 3.4. For a Lockheed Martin and British defense, it's about less than 1. Limited point is that if we compare our Indian companies vis-a-vis global peers, we look expensive, and that can only be justified if our growth is very, very strong. Unfortunately for us, earnings growth is slowing down. So is EBITDA growth. So is PAT growth. In first quarter, June 24 numbers, the upgrade downgrade ratio also has come down to almost last couple of quarters bottom end. For markets to deliver better return from here, this earnings must be achieved. 11.15 for Nifty 50 EPS this year and 13.16 next year. Earnings growth of about 11% this year and about 18% next year. Another interesting thing, number of stocks which have doubled from Jan 20 to September 24. In NSE 100, 74 stocks have doubled. In BSE 500, 332 stocks have delivered more than double the return. Effectively, this has been a pure betting pitch where even 10th number batsman could come and hit a century. If you look at companies trading at 50 plus PE, and 50 plus PE means discounting 2074, 50 years from here. On Jan 2020, 79 companies out of BSE 500 were trading above 50 PE. Today, 224 companies are trading above 50 PE. Almost 1 out of 2 companies are discounting 2074. This is the most important slide of this presentation. 20-year return between 05 to 24 was 13.31%. But last 4.5 years return from Jan 20 to August 24 was 21%. And 15 years before was 10.9%. Now you can very well take a call of what kind of return is going to come in next 5 years, next 10 years. We believe returns will be more over here than this. So please don't invest keeping in mind this kind of return. You are likely to get disappointed. Our view remains with large cap, valuation premiums in your favor, and marginal underweight small cap with overall neutral equity weight. Don't be overweight, don't be underweight. Within your portfolio, choose quality over momentum. ये मार्केट में गधे और घोड़े दोनों भाग रहे हैं, and कुछ किस्सों में गधे are running faster than horses. They can do it for 100 meters, 200 meters, but they can't do it over 10 kilometers. So quality over momentum, please be careful about it. There are stocks which have high floating stock and where market price gets discovered by market forces. There are stocks where floating stock is concentrated or low, and hence market prices, while they are traded in market, are not necessarily open discovery. Please keep high floating stock market discovered prices in your portfolio. Go for reasonable valuation over expensive valuation. There are companies which are discounting 3074. Who knows what will happen in 3074? At this point of time, market is positively discounting everything. US Fed in September, they will cut rate. 5-year government will run. Oil prices, no matter what happens in Middle East, will be around $80 and below. Consumption will recover with good monsoon. Geopolitical risk will remain contained. And earnings growth of 10 to 18% for this year and next is likely to materialize. Anything going wrong over here will have material impact on market, as market is pricing in everything positively. On the investment side, SIPs, after a long period of time, almost all our funds have delivered on rolling return positive alpha in both equity and hybrid. If you look at point-to-point return, the gap has started narrowing down significantly. At one point of time, our negative alpha was -9%. Today, it is -2%. Hopefully, as Gadhe starts slowing down, this will become positive. If you look at point to SIP performance, again, there are few funds where the numbers are high, like small cap -7%. But again, we believe when momentum plays out its game, quality stocks will outperform and these numbers will become positive. Despite the noise, funds continue to deliver positive alpha over benchmark despite challenges of managing money at this size. One fund which you can look at is Kotak Technology Fund. We believe technology sector is reasonably valued. Volume growth is expected to come back, and the productivity level is going up thanks to adoption of artificial intelligence. All these things should result into re-rating of this sector going forward. The second fund to look at is consumption fund. Election spending, monsoon, and budget all put together should result into consumption picking up over a period of time, and that will be reflected into our fund performance. The other things which are worth looking at is Kotak Equity Opportunities, blend of large and mid cap, contra fund biased towards value, and multi-cap fund which has allocation across large, mid, and small. We also have a fairly large portfolio of passive funds which try to mimic index and slowly and steadily will continue to add into our portfolio of passive funds, as well as launch wrappers around passive funds. On the fixed income space, US inflation is declining. Clamor for rate cut in US is increasing. Market is expecting 3 rate cuts, one of 50 and one of 25 over in this year, calendar year 24. The US Treasury yields have also declined significantly compared to last year. Globally, also 10-year yield in major economies have started coming down. In India, since government has pursued the path of fiscal consolidation, and expectation is about 4.9% fiscal deficit this year, the supply of government securities will remain restricted, and hence government interest rates or yields on government securities should continue to come down. In India also inflation is eased and CPI inflation is now well below RBI's target range on the core inflation. Liquidity RBI has managed well, partly due to deposit pressure. Overall, we believe we have strong macro story which will support buying longest possible maturity of fixed income. In fixed income space, our call has remained for some time by the longest possible duration as interest rate cycle will play out. There is also potential chance of India's credit rating upgrade in FY26. If we can bring down our combined fiscal deficit below 7%, where there is a reasonable chance there could be rating upgrade of India, and that should result into further tightening of interest rates. On the debt side, hybrid funds will be more appropriate for those customers who are looking at slightly higher risk and slightly higher return.
So we are coming out with a first sectoral fund in debt side. Yeah, so we're coming out with the first sectoral fund on the debt side, which is named as Kotak CRISIL IBX AAA Financial Services Index Fund, and which the NFO is already on. So it will be concentrating in the underlying NBFC and HFC and some of the PSU bonds as well. Namely, the index is constituting of 15 names, around 15 names, but not necessarily it will be following index in an identical fashion as the index is, because this is the question we normally get it, that if the weightage is around 5% in the each name, are you going to follow it exactly the same? No, it is not exactly followed like that, because in the fixed income side, it is normally the accrual, and therefore, and the behavior is almost similar on all the names, unless until there is some rating change or some kind of action happens. So what we try to do is we try to take the highest yielding possible, which is matching the maturity of the index, and we try to concentrate the portfolio in similar fashion. And therefore, you will find that there are around 7 to 8 names on all possible times in the index. And the USP of this particular fund is that this fund is likely to deliver some amount of alpha, some amount of additional return over a normal AAA PSU fund. And as per the yield curve, this the maturity date of this fund is end September 2027. And it is likely to run down till that time, and it is likely to mature in the end of September 2027. And normal AAA PSU or a mixed fund, normal AAA PSU fund or mixed portfolio, traditional portfolio is yielding somewhere around 7.5. And as of now, in the market, we are getting a yield of close to 7.90 to 8% if we construct this portfolio, as you can see in the AAA sectoral fund. So that is the advantage for some individual who's not keen to take some amount of volatility on the fixed income side and is looking for deployment on the shorter end, which is 2027 maturity. So those people are looking for this kind of fund can come into this particular NFO, and this fund will be open. It's an open-ended fund, can come in and go on any time, can look to invest in this particular fund. So that's all for me. In case any question, you can take it.
On gold, by and large, we have remained bullish since COVID time. In 2021, that call didn't work, but our view was over 3 to 5 year period, and in all those periods, gold has delivered better return than fixed income. The rally in gold is driven by central bank buying. Every year, they have been purchasing about 1,000 tons since last 2 years, and that should continue going forward. Gold share in global FX reserve is now about 17%. we believe it should continue on the higher side and will probably see gold reaching somewhere the levels it had in global FX reserves around the mid-70s. Another reason for bullish gold is driven by US interest rates. Every time US interest rates have started coming down, gold prices have run up. This time also there is expectation that now US interest rates will start coming down and hence gold prices should get supported.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.